Hi, this is Randy Finney with Right Side of the Chart, and this is a mid-session update for Tuesday, January 12th, 2021. What I want to do in this video is analysis of the market-leading FANG stocks. Those are what I've dubbed the top 5 in the Nasdaq 100. And then what we'll do is go down to about the top 10. The Nasdaq 100 has been for many, many years, if not decades, the leading index. You have your a heavy weighting, a much heavier weighting towards technology than the S&P 500, and that's where growth has been in the economy for quite some time now, for many, many years. And therefore, bull markets, it tends to pretty sharply outperform the S&P 500, and that cuts both ways too. When the market turns, the Nasdaq 100 tends to fall more than the S&P 500. But most importantly, it's more of a proxy or tell of the market-leading stocks. And again, I'll go over those in a second here. All the the largest companies in the world are tech companies like Apple and Microsoft and Facebook and the likes. And so they're also the top components of the S&P 500, and tech is also the largest sector in the S&P 500. So again, by looking at the Qs, it's just given us a little more concentration on the most important sector out there, because that's what's going to move the S&P 500. Even being the highest weighting, you're not going to see a tech wreck or a correction in technology with the S&P 500 going up. It doesn't matter. I know tech is only one of 11 sectors, but it has to do with the heavy weighting that it has. So, all right, enough on that. Before we get into the FANGs, and the video will be relatively brief, so we're only going to cover about 10 stocks, and I'm going to look at 2 time frames, mainly the daily and the weekly charts, to give you the sort of the intermediate term picture, and there's some levels to watch. I wouldn't be doing the video if it wasn't, if there weren't some things to point out here. All right, let's start out with just the currencies. As you guys know, if you followed me recently, unless you're just tuning into the site now for the first time in a while, checking in, I've been focusing more and more lately on a couple things: Treasury bonds as well as the U.S. dollar and the euro. So here's the euro-U.S. dollar pair. It's flat today. Right here you can see in the upper right-hand corner, 0.00, that was exactly flat as I'm doing the video. So we're taking a breather. But what happened recently is we had a sell signal, pretty powerful sell signal, a breakdown in the euro and a breakout in the dollar, and that's caused some impulsive selling. And again, I would encourage you, if you're just checking in now, look at some of the recent posts I've covered several times in both chart images that I posted on the site, some screenshots, as well as in the videos. An extremely tight, almost perfect correlation between the euro and the stock market, which is also an inverse correlation between the US dollar and the stock market. So in other words, for months now, the dollar's been falling while the stock market's been going up. And recently we've had like I said, a very key, very clear to me breakdown in the euro and breakout in the dollar. I'm sorry, breakdown in euro, breakout in the dollar. That's what it is. So what's going on today? So we're flat. By the way, the whole point of me starting out here is, it's no coincidence the dollar's flat, as is the euro, and therefore the stock market's flat. You can see the stock market's, right now, kind of hanging in there doing nothing. S&P 500, as I'm doing the video, is almost exactly flat, slightly down. Same with QQQ, down. I don't know if you can see it in the video. SPY was down 0.4%. QQQ is down 0.6%. And back to the charts. All right, so just a quick update. That's all we're doing. We're consolidating on support. This was my first target on euro-US dollar pair, 121.623, and that's right about where we're at. You can see we're trading right on there. So there's a little momentum fueled overshoot, and that's what happens. This is why I list multiple price targets on trade ideas and in any other asset that I'm analyzing, is because it's my expectation, and more often than not, you're going to get a reaction on the initial tag of that level. So this is a reaction. I define a reaction in one of 2 ways: either a consolidation when you're falling and you hit a level, or if you're rallying, the reaction would be on the initial tag. You can either consolidate or have a pullback, either or. Sometimes the reactions occur more in time than in price. Sometimes you bounce. But the key is, if I have additional targets and if I favor additional targets, that is that's where we're going to go, or at least that's my expectation. And then, well, what tells you when we're going to start going there? When's the next leg going to come? Well, once we move away from this target. So really now, since you overshot it, we've been bouncing around. Pretty much a break of the recent lows in the euro US dollar pair. Again, that's that was just a 60-minute chart. This was a daily chart I started with, and then you have for you futures traders, the US dollar, same thing. These targets were laid out in advance. This was my first target here at 96.11. We hit it yesterday, and there's your reaction. You hit it, we're consolidating, and your next buy signal is going to come when we take it out, and that should run the dollar up here at about 91.081, and that should most likely correlate with another leg down in the stock market or a drop in equities. And the thing is, and again, this is why I'm doing this video, guys, I'm always looking for an edge. I can assure you there's not a lot of people focused on the dollar right now. If they're trading the stock market, they're looking at the market. And so there are times where one asset class or one security can give us a heads up, and that's what I'm looking at here. So I think this is, I believe pretty strongly, should this play out as I expect with another leg up, and maybe we take that level out, the more upside we get in the dollar, the more likely it is to put pressure on the stock market. And the more the dollar goes up without the market dropping, I think the quicker or more powerful the game of catch-up will be when the market finally breaks. So that's why I'm doing this video. Now, look, okay, the breakout happened. That's already there, and that also caused a drop in the market yesterday. Since the breakout. Again, we're consolidating today. We're flat. There's I don't know if you can see it in the bottom corner. U.S. dollar index futures are flat, down 0.06%. So we could fall back here, and that would most likely, not absolutely, but most likely correlate with a bounce in the market. But this is what I favor. And again, when does it happen? Probably soon. We've had a pretty decent, we consolidated here for since yesterday, hitting that target. And then on the euro futures, same thing. I had a first target of 121.94. We hit it, overshot it just ever so slightly. In fact, you know what, now I would add this. There was some support there, a couple reaction lows there. And now most recently these reaction lows. So we'll put a line here right about the recent lows. And that's what we need to do now. To get the next leg down, we need to take out this recent level of consolidation, and if so, which is still my preferred scenario, that takes us down to the next target, and if and when that goes, the next target down there. And if that happens, remember, it's been almost a perfect correlation. I've showed you on the charts. November 2nd, that's when the market had a major reaction low, the stock market. And if you overlay the S&P 500 with this chart of the euro futures, it's going to look just like this, except this. See, that's the thing. We had this breakdown, and the market, although it was down yesterday, as I said, it hasn't dropped as much in relative terms. And that's why I think that's why I'm doing these videos, trying to tell you guys I think it's time to, if you're aggressive, take a starter or even a full position. You can manage, you should always manage your trades, have your stops appropriate, depending on your price targets. Now we're going to get into some other levels to watch, especially on the market leading stocks. So, okay, back to QQQ. And now what I'm going to do is click on a watch list. When I pull up the Qs or any ETF, I have a watch list that's loading off to the right of the screen recording here. And I have the components of the Nasdaq 100 sorted by market cap. So I'm going to click on the first one. That's Apple. This is the largest company at $2.2 trillion. That's a big boy. And it's going to, because it's a big boy, heavy weighting in both the S&P 500 and the Nasdaq 100. So this one will definitely have an impact and moves the needle quite a bit. I haven't updated in a while. Somewhere on here I used to have the weightings, but we'll skip that now. You can look it up. Just Google QQQ weightings, and you'll get those. All right. So what are we looking at here? The most important development on this chart right now, and this is just a development, is this divergence. We have, for the first time since back here, and that was right before the what I call the COVID drop into the March lows, we have clear negative divergence on both indicators. I had highlighted back a few months ago at this high right here, we did have RSI divergence, and that led to Just divergence on the RSI was a catalyst for this 25% drop in Apple. This last time we had divergence on both the RSI and the PPO, those two indicators below, that was a 35% drop followed in Apple. That was, I'm not going to call it small, normal divergence. This is big divergence. This would indicate the potential for a much larger drop. Now, we say divergence is not a sell signal. It's merely an indication that a trend reversal is likely coming. And so this is negative divergence, so it would typically portend a a correction. What needs to happen? Well, you can see I have a uptrend line in Apple, and this is a major uptrend line. A lot of stocks are finally starting to give us some nice clean uptrend lines from those major reaction lows back in March. After the market melted down when COVID was first really becoming a thing. So there's a trend line. But I also have, as you can see, support here at 125.75. You have a major reaction high right there. Tested it. We broke out, back tested. So that's it. If you want to set a price alert, we're kind of flirting with the trend line recently, and that's why this is the number. In fact, I'll do that right now. I'll set a price alert, and once we take that level out, if and when some of the other market leaders start to break down, that should open the door for a move down to 106.48. Now, what do I mean by that if and when? Well, what happens is if, let's say, Apple breaks that support level, but then all the other FANG stocks and the majority of the top components in the Nasdaq 100 or most tech stocks, they rally at the same time, continue to rally. That'll probably prove to be a whipsaw, and then maybe we back test, or maybe it's an outright whipsaw signal. We go to new highs. But as of now, keep it very simple. That's what I'm looking for. And again, I'm starting out here with the largest components, so it's going to have a big impact. This one, if it breaks down, especially if you see an impulsive move down through there, a solid close below, that's going to be a sell signal in Apple. Now, I'm going to do this on each of these 10 stocks. We're going to look at the weekly chart too. And this is a weekly of Apple. It paints the bigger picture. Let me just toggle back before we get to that weekly. Here's the previous divergent highs. I haven't measured. I just told you a minute ago, I think, that this one was a 35% drop right there. These aren't measured out, but I can tell you right now they're well into the double digits. There's a 22% drop. That's double digits. Some of these in the past I had measured out. These are all the divergent highs in the past. Each and every one of them I had marked on this chart. And they're all, every single one of them, except that was 9%. All of them have been led to double-digit corrections, or were followed by double-digit corrections. So where am I going with that? Again, this is the largest divergent high right here that we've had in quite a while. And so now what we need is that catalyst, i.e. a sell signal. Because divergences are going to build in an uptrend. I'll talk about divergences for days, weeks, months, and sometimes when we're going on the weekly charts, even years they can develop over. So that's it. Where's Apple likely going in the long run at some point, and who knows when? 2021, I believe, some point. Come back to this trend line here. This yellow trend line is a very well-defined trend line. And anytime you have these primary long-term trend lines on a stock, this one goes all the way back to 2009 right here. The stock will come and visit that from time to time, and it's normal. So if it did that, it's going to be a bearish thing, certainly, to get there. I'm going to measure it out for you and tell how much it will be. But longer term, Apple's a great company. It's in an uptrend. This is it's in a long-term bull market. But within a bull market, you're going to get these corrections every so often. You had one here, and again, the farther you get away from the trend line, like this point right there, boom, you come back, and there's a reversion to the mean. And that was a 45% correction. You got away from it here. You had a 34% correction. You got away from it there. You had a 39% correction. That one, you came a little shy of a 35% drop. What would it mean for Apple to come back and visit it? Well, it depends on when it gets there. The longer it takes to hit that level, the less of a drop it is. If you dropped straight down, then it's not going to happen, in the next week or two. But if you did, that's about 57, 58%. If it took a while to get there, if we zigzag down and hit that level, this would show us hitting it sometime, let's see, that in mid-February, or mid-October of this year, where I'm holding the crosshairs, and that would be about a 50% drop. I know that's, heresy for Apple bulls, but it's again what the stock does, and it's normal to see that stock every so often come down, even in a bull market. Remember, this was our last bear market, and the stock fell 62%. Here was a 45% drop off the highs in a bull market. There was a 40% drop. So, anyways, that's, I think, a likely target longer term. Now, again, how do you get there? How do you manage it? Well, first things first, and that would be to get the sell signal on the daily and then just see how things look if and when we get to that target down there. That would be my minimum target at this point in time. Should we get that sell signal? And that would be a drop of about 17%. So let's just focus on that number right now. Should we get a sell signal in Apple and the majority of these other stocks I'm about to roll into? Next up, Microsoft. Microsoft, this is a daily chart, and the way I have it drawn right now, I have a symmetrical triangle pattern. Similar to that symmetrical triangle pattern that I highlighted on Treasury bonds recently and Treasury yields. If you recall that, I'll show you an example. Again, if you're catching up. ZN, this is the 10-year Treasury bond futures, and just recently I highlighted the symmetrical triangle pattern, and you get compression here, price compression, the range gets tighter and tighter, and then boom, once you break out, in this case, it was a great example of it. I mean, I talked about it before. It happened like being energy, like a coiled spring, and boy, there was some energy released right there. Treasuries continue to fall. That's similar to what I'm seeing right now on Microsoft. And so we'll watch that. There's also quite a bit of support. I'm going to add one more line here. You know what? I need to give you a level right there. There's another level to watch. But the big level to me, which would really open the door for much more downside. And remember, guys, by the way, I'm talking about the downside levels. If this breaks up, just like Treasury bonds, I thought Treasury bonds were likely going to break up because of what was going on, how the market was setting up and how the currencies were setting up, and they went the other way. And I said that before it happened. You've got to respect it. Triangle can break either way. So that would be bullish for Apple, or Microsoft, I'm sorry. And there's also some price support or resistance above. There we go. Quite a few reaction highs. So it's not... The lines on Microsoft, there's not a hard line where boom, if it breaks, because if it does break up, you have reaction high there, one there, and then one a little bit higher. But obviously, if it can break out above the triangle and put all those 3 reaction highs or 4 reaction highs in the rearview mirror, that's going to be bullish for Microsoft, at least near-term bullish. Now I'm going to get to the weekly chart in just a second and show you why I say near-term bullish. However, a downside break, which is what I'm leaning towards now because of what's happened in the currencies, I think the time is right. Downside break, these are your support levels that are marked. And the big one here is at 201.35. Why is that the big one? Because this is the trading range. If you turn off all these lines right here and just use a simple box tool, you can visually see Microsoft, like a lot of these fangs, have topped out. And I don't want to get too much off topic right now, but it is relevant. What's going on in the political arena. Now, I implore you, please keep politics off the site. I keep them off the site unless it is directly related to a trade, a particular stock, or the market. And what's going on right now with Twitter and Facebook, maybe to another lesser extent, Alphabet, Google's parent company, is that pushback from, there's quite a bit of conservatives out there, whether you're a big Trump fan or not, that don't like what's going on with the, repression of speech and, blocking the president and all this. Again, please no comments on that. But what we do know is, a lot of people were canceling their Twitter accounts and Facebook accounts and moving to Parler. Then they shut Parler down, and that infuriated them more. And there's another platform out there called Gab. And so where I'm going with this is, what impact is that going to have? We're going to look at Twitter and Facebook here in a second. That could have lasting implications, at least in the near term. We'll see. Maybe it's a one-off thing and everyone's going to forget about it and get back to tweeting and liking all their friends on Facebook. I don't know. Again, I'm not a big social media fan myself, or user of social media. but I just wanted to mention that as a fundamental catalyst. And again, also what prompted me to bring that up is most of these market leaders, stock market, we hear about new highs, new highs, new highs every day lately. Not the market leaders, and that's something that investors for many years, seasoned investors have watched. You keep an eye on the market leaders. That's usually a tell in the market. Now they may be consolidating. They may be just taking a breather. And if so, when you have an area, especially multi-month, several months of consolidation, the longer you consolidate, again, it's like energy building like a coiled spring. So that could be longer term bullish. I just want to be very clear if we get those upside breakouts. But it can go the other way too. It could be pretty bearish if we break to the downside. So that's what Microsoft looks like. There's my lines and levels. And if that's a big one right here. I'm going to move the line down a little bit now. And what I'm doing is I want to cover these recent reaction lows right here. Let me circle them. If I can get a circle tool here. All these reaction lows at the bottom of that trading range. So that's right about 199. And a break of 199 would take us down here. This would be a target zone, about 187 to 180. And it's pretty good fall from where we're at now. But before we get there, there are some minor support levels along the way. Now, quick flip over to the weekly chart, and you can see this goes back. I mean, we can roll back as far as we want. We can go back to the, early 90s, but let's just look at modern charting history of Microsoft. And you can see, again, these divergent highs, 21% drop, 15% drop. Microsoft doesn't have a lot over the years, but when you get them, they're pretty darn, it's a pretty darn reliable indicator that a correction's coming. So there it was, 21% drop. Next time we put in a divergent high, and I'm referring to the indicators down here, negative divergence, 15% drop, 19% drop. And as you can see, this recent high right here was the first divergent high since that 19% drop back here. So even if let's just say you are longer term bullish on the US economy and the stock market, you see new highs and beyond in 2021, 2022, that's great. But you don't want to ride out a double-digit pullback, especially north of 20%. And I could tell you that's the just recently we put in the first high. Now, what I was getting to a second ago is, look, if we happen to pop that triangle to the upside, it's not going to change much technically. All you're going to do is extend the negative divergence, both here on this weekly chart as well as the daily chart. So I think any upside is going to be limited. And we're still looking at a stock that has divergences that have been building, and any new marginal high anytime soon are still going to be a divergent high and set the stage for a significant correction. So like I said, to me, if somebody said, Randy, you have to put a trade on Microsoft and you have to leave it alone for 6 months or so, or 20%, till you make 20, would you be long or short? I'd wait for the short now. Wouldn't be going long Microsoft here. I think the upside's limited. That's my opinion, and that's based strongly on the charts and a lot of other things that I've covered recently. Next up, Amazon. Let's start with the daily chart. In Amazon, same thing. You can see I forget about all the other lines. They're just old lines, but here's another symmetrical triangle pattern. And also pretty nice support here. That's about 330.87-ish. Give or take. There's some price support there, and you can see my other levels. I think you can see them here: 29.43.50, 27.86.50-ish. Those are some near-term levels or potential targets. This high right here was a divergent high, and then we had a breakdown. And by the way, from that divergent high, again, it's not as if these divergences don't work. They more often, not always, but more often than not, play out. That was good for a almost 20% drop. And since then, that was the high. We've never exceeded. We've been making lower highs, but also higher lows, and that's the nature, again, of a symmetrical triangle pattern. So respect which way it breaks, and I've given you my thoughts on where we're probably going. Longer term, bigger picture. Here's a long-term uptrend line for Amazon. Comes off the late 2008 lows. Not sure if a lot of you remember, but the stock market, the S&P 500, small caps, mid caps, just about everything bottomed in March of 2009. However, the technology sector and the Nasdaq 100 actually bottomed in late 08, and that's where this trend line comes off of in the fall of 2008. And there's our long-term uptrend line. So why is that significant? Well, we had that one reaction, major reaction low. We had another check of that trend line, if you will, back here in 2015. Another check right here in early 2020 when everything fell. And that would be a logical target to come back down to that trend line again. All right, so that's what we look like. Oh, and I already showed you the divergence on the daily. And again, if we happen to push up and these triangles in the market breaks to the upside, or these market leading stocks break to the upside, anytime in the near future, we're talking months out, you're going to have severe, strong negative divergence. That's if we get another thrust up. So again, that's why I think any upside this year is going to be limited before we get a decent correction. This market's got a lot of hot air in it, and more so in some other stocks in these fangs. You know, you can certainly, we'll get to one in a second here, Tesla, for example. But all right, let's just jump on to the next one. Facebook had a triangle pattern. And remember, Facebook is one of the casualties of what's been going on in the political arena, you know, with the censorship. And you know, I've heard there's quite a few people that have stopped using the platform. And, you know, that would be, you know, these companies, these fangs have been bulletproof in recent years with all these, you know, talks about the government bringing, you know, antitrust suits against them, and, you know, anti-competitive practices and all this. The government trying, and it seems they just brush that off. But I'll tell you what's going to kick Facebook and Twitter hard is if they see a drop in users. So just keep that in mind from a fundamental perspective. Technically, we already broke the triangle pattern. Then we broke, I had support here at 265.10. That recently broke, and we're coming up on the next support at 247.60. But we already broke down and back tested the triangle. And where does it go? Well, let's look at the long-term chart. Weekly chart. Here's my primary uptrend line, comes off the 2012 lows. Remember, Facebook only went public in 2012. Here's a long-term trend line, bull market trend line, that it visited here on a 44% drop. You know, you get away from that trend line, the primary trend line, and you're going to come back and visit. We had a little brief momentum fueled overshoot during the meltdown into the March lows earlier in 2020. That's still a valid trend line, I believe. And let me give you one other level for you Facebook fans. When I say that, I mean anybody interested in maybe shorting or going long. 216-ish. That would be a swing target on here on the weekly chart. That's a pretty nice level, because I see, you know, major reaction high there, another one there, another one there, broke above it, back tested it right there. So give or take, that's not a hard number, but about 216 on Facebook. Next up, and we'll just cover about 5 or 6 more. Tesla. Tesla keeps doing its thing. Here's a I have a primary trend line right here that it broke, and it's been back testing. So this right here looks like the reminds me of my 60-minute chart on the US dollar futures. I'll show you that in just a second. You have a primary trend line, you have a breakdown and a back test, and then you set up almost a parallel trend line. You have this like price channel going here. The divergence continues to build on Tesla. There's my minimum target right here when this line breaks. We'll call it 465, minimum target. Second target, 334. Here's what Tesla looks like on a weekly chart. This one had big divergence right here. And that divergence, and I often talk about this, divergences can play out one of two ways. If you get a correction, you can correct in time and or price. You know, a price correction would have been something much more like this, back down to the trend line here. But what happened is Tesla put in this divergence, and this was a multi-year trading range. It's boxed in red right here from 2013 all the way to 2016. We broke above the range, and then we set up in a new range here. And that also had divergence. And by the way, there was a healthy correction. It doesn't look like it on this chart, but from that high, when this was a divergent high right here, the stock fell 54%. I use log scaling. If you don't use log scaling, it kind of throws everything off, in my opinion. I'm a big fan of log, so this is what it looks like if you don't use log scaling. This is why I use log scaling. It makes no sense to use arithmetic or linear scaling on looking at a stock like Tesla or anything that's grown, because you can't see. It looks like it did nothing here and then exploded. That's not the case. Log scaling simply puts the moves in percentage terms, because when you have a, let's say a $10 stock and it goes up $1 a share, that's a 10% gain, right? Now when the stock reaches 100 and it goes up $1, that's a whopping 1%. So log scaling fixes that, and it puts the candlesticks proportionate in percentage terms. I just want to say that because I've over the years had that question put to me on the site quite a bit, and I think that just gave you a good example, toggling between turning the log scaling off. All right, so where's Tesla going? You Tesla fans won't like it, but here's our primary bull market uptrend line. At some point, we're going to come and visit that trend line. It's going to be catastrophic for Tesla and the S&P 500, which it's now a part of, but that's where I think we ultimately go. Where do we go before then? Right here. On the weekly chart, 388.50 give or take. There'll probably be, I can give you a first target if that's too aggressive. I know some of you are saying, Randy, you're crazy. Tesla's not dropping down to 388. All right, first target 464. That would be a drop of about 45%. That second target would be about a 54% drop. So let's just leave it there and see if when we get the sell signals on Tesla. Again, divergent high, correction. Not just in time. Again, that was way into the double digits, as was that one, 45% or something. And here's our third divergence ever on the weekly chart in the stock. And although the divergence isn't as big as this divergence, it's actually more steep and pronounced. That's a sharp. I look at two things. I look at the magnitude or the scope of the divergence, and also the lines. How steep are they? How steep are the divergence lines on the indicators, or how steep is the advance in price? And in the stock market, I can just tell you, typically the steeper the advance, the sharper they rise, the harder they fall. That's just how things tend to work. Okay, moving along. We're almost done here. Well, about halfway done. Well, at least we're done with the FANGs after this one, FAAMG. Here's Alphabet, Google's parent company. There's a trend line I'm watching. The trend line comes off the March lows. That's a primary trend line. We now have enough reactions. A few weeks back we didn't, but there's enough distinct reactions to validate that trend line. This is your divergence line. We had a divergent high already. So the stock has put in a divergent high, and that may be it. And that's the way I'm leaning right now. But as you can see, I've extended this trend line. Should we have another thrust up, it's simply going to extend the divergences. So at best, my most bullish scenario is marginal new highs in these FANG stocks. What does that mean? Less than 10%, above the previous highs, somewhere in there. It depends on each one. But we already put in the divergent high. So now what I'm watching is, and I like this setup. You have dual support levels that are intersecting right now, the 1710 right there, and that price level, and the uptrend line. So boom, a break of that. There's a big old gap right here. Let me show you the gap. There's a major reaction high there. Since we took it out, we gapped above that previous high. That was bullish. That's a breakout to new all-time highs, or was at the time. We backtested, backtested, backtested. We've been backtesting. Should we break down there, what's going to happen is this breakout to new highs will fail. A few things are going to happen. You're going to fail the breakout. You're going to fall below price support. You're going to fall below trendline support, and you're going to trigger a head and shoulders pattern breakdown. There's a nice head and shoulder stopping pattern with your left shoulder head right here, which is taller. You can Google that pattern if you're not familiar with it. And this is your right shoulder. And this is your neckline right here, that same 1710 support level. So that would take us down in the measured target of a head and shoulders pattern. You simply take the distance from the neckline up to the head, and then you add that to where it breaks down. So that would take you somewhere around here in Alphabet. Weekly chart. There's some levels. Divergence has been building. I'm going to go a little faster to wrap the video up here. NVIDIA. There's a trend line to watch right there on NVIDIA. This was a divergent high right here. I don't have it labeled on the chart as such, but that's what that was. Equal highs with lower lows on the indicator is negative divergence. So we need to see this trend line break to get a sell signal. We had a little whipsaw there. And then these are your first two targets, about 471.50, and then 430.22. And again, remember, I'm doing this video, take this collectively, all these stocks. If one breaks down and the rest don't, guess what? The market's probably not going to go down. If the majorities break down, and you'll probably see them one after another, all these levels I'm covering for you today will break down, and usually I get these price alerts like popcorn going off when the market finally breaks, especially after a market that's full of hot air like this one. These are just some long-term bear market targets for the next bear market on the video. I'll move on to PayPal. PayPal, there's your uptrend line, divergent high, and again, it's not as if these divergences don't work or play out. 19% drop on that divergent high, and another 19% drop, and it's the same divergence, it's just getting bigger, it's been extending. So my expectation is now for bigger, drop larger than 19%. When this trend line breaks, your first target's going to be 216.44, and then I think we come on back down again to that 174.27 level, and that would represent a drop of about 26.5% or so in PayPal, and this is what it looks like on the weekly chart. Big steep divergence. Again, this is a common theme, and that's why I'm doing the video. That's why I spend so much time. I know these videos get long, but that's some pretty sharp divergence. That's just a big old bearish rising wedge pattern is what that is on this weekly chart. So this is what it would look like. You know, move down to 173.50-ish, reaction there at minimum, and that might be it. That might be it for the correction. Maybe we go to new highs from there. But if we end up breaking that level, it could bring us all the way down here to 123, and that would probably, yeah, if I extend that out, I'll tell you, this fits. And when things fit, that's usually the path it's going to take. So this would be a long-term swing or trend way to trade PayPal. This is how I'd expect the correction to go. Drop down to 173.50-ish, market and everything rallies for a while. You know, tradable rally where you want to cover that short, get into longs, go long PayPal, ride the bounce, then reverse short for the next ride down to that beautiful intersecting primary uptrend line plus price support level. That'd be my scenario for PayPal there. Comcast, nothing much on the weekly chart that stands out. Little megaphone pattern here on the daily chart. Again, one of the top components, big level. If and when we get that correction in the market soon, like I think it's coming here, Comcast is going to come back down here and retest that 47.20. That's a big level. That was massive resistance right here, and we broke out to new all-time high there. And again, if you're bullish and you're listening to me at this point in the video, if you haven't shut it off yet, there's takeaways from this. Look, this is where if I thought Comcast, and maybe I might be stepping in buying Comcast here at 47.20 for a trend trade or a long-term swing trade. But my point is that's where the next objective level. It's not objective to buy the stock right here. It's kind of floundering around, going sideways recently. I look for objective entries and exits on my stock, and that would certainly be an objective long entry. Whether you want to just game a bounce and you think it's going lower, cover a short. But again, that's big support right there. All right, a couple more. Adobe, little trend line. You can see it has a pattern. This is a daily chart. These little minor uptrend lines, you get a break and a correction. Break, correction. We just broke this one, back tested, and I'm trying to see if I can add another. Yeah, you know what? There needs to be a support line right here. Some of these charts, I haven't updated these levels in a while. That would be your first target, about 424.60, and for support coming up when that breaks, 451.62. Netflix, you can see my boxed in trading range right here. Again, the common theme, a lot of these market leaders have stalled out. You can see Netflix has just been bouncing around. That's big support, about 467, the bottom of that trading range right there. And that's where at minimum we're heading, I think, in the coming weeks here. And then if that breaks, you had a trading range here, but it was thin all the way down to here. So this would be, again, if we take out the bottom of this trading range, this 394 to about 384 level, that's a target zone for Netflix. And the bullish scenario would say, if the stock can come down here, you can buy it at the bottom of this trading range again. It's simple stuff. When you see a trading range, there's no guarantees, and I can, well, actually, one guarantee, a trading range will not last forever. And what I was going to say, there's no guarantee that this strategy will work, but it's super simple. You buy pullbacks to the bottom of the range with a stop somewhat below in case that range finally breaks to the downside, and then you swing it back up to the top. And had you done that, each and every time before, or even the midpoint, I have a line in the midpoint that often caps rallies. If you get that trade and we happen to have another move up to the top of the zone, you're talking 23, 24% in Netflix. Or you short a break of the bottom of the channel and you're looking at a drop of roughly 15, 16%. Netflix long-term trend line right here. This is a weekly chart, comes off the 2012 lows, and see, here's the thing. That's going to be pretty bearish if and when that goes. And if that trading range I just showed you breaks, this level's probably going to go. There's your negative divergence, big divergence, been building for years in Netflix. And I think ultimately this one can drop all the way back here to about 200 or so. There was a divergent high there, divergent high there, divergent high. And just like you look for divergent highs, you look for divergent lows to go long, cover shorts, and get long for the next uptrend. So that's it. That's a pretty precarious looking chart for Netflix. But let me say this. A trend is a trend until it's not. This is an uptrend. So if you're bullish, you can buy pullbacks to the trend line. Sometimes these divergences can continue to extend for quite a while. Sometimes they get burned through, meaning you take them out. So you can look at a glass half full and buy a pullback to the trend line, or you can look at a glass half empty and short a break of the trend line and try to swing down to any of these targets there. Finally, last but not least, if you're still with me, Intel. Intel, this is a daily chart. The last time I updated Intel was back here on November 16th, earlier this year, a few months ago, and it was actually one of the most bullish stocks that in the tech sector, and certainly in the Nasdaq 100. And I'm trying to zoom in here. I'm over zooming. Sorry guys, I'm having a hard time with this. Let me pause the video, see if I can get that sized right for you. Okay, and it's a little blurry. Basically, I said Intel has been lagging behind the rest of the semis, but with one of the most constructive bullish charts at this time. Recently reversing off a major support zone, that's this right here, with positive divergences in place. Any or all of these levels are potential price targets. And that was again in, was that early in November, and that was then. This is now. It was right here, and boom, there it is. There's that $53 was that the highest target I had? No, I had 52.74 right here, and then 56.18 or 56.16, something like that. And so that's it. Must have been a different board. Yeah, there it is. This is the board I was showing you. So we've hit now my third target. Kudos to you that caught it. And yeah, again, it's still one of the better looking semis in my opinion, and one of the better looking fangs. But here's the thing. Again, if the fangs of the rest of those stocks break down, this one will break down. We are above that 52.74, which technically opens the door for a move up to my next target. However, this could be a brief momentum fueled overshoot. If the market breaks down, that's what that'll be, and that will be where we correct from. So yeah, at the very least, based on where I think everything's going, at the very least I tighten up stops, if not outright book profits if you happen to grab this one or are in it now. And if you raise stops and it continues on up, then that would be the next target there, 56.15. But I think for now, if the market corrects, it's probably going to drag Intel down with it. And so that's it. This is just a longer term chart of Intel. I know there's a lot of lines on here, and you can see, semis are volatile. These are the corrections after the divergent highs in the past, throughout the bull market since 2009, late 2008. 28% drop, 34, again off the divergent highs, that's where it's measured, 34, 14, not 32. That's my prediction from back here. When before we broke this bearish rising wedge, I said 34 or 24% drop, and then go on and ultimately work our way down here if that target's hit. So We're flirting with the bull market trend line right now. We had a brief move down through it into the meltdown in the March lows last year. We're right above it now. That's going to have longer term bearish implications if it's taken out. So just food for thought. And again, Intel will most likely ebb and flow with the rest of the market, with the Nasdaq 100, and it's due largely to inflows and outflows, of course with sentiment too. If the stock market takes a 10-20% correction, sentiment will change, and then you get the outflows. And then what happens is, because Intel is heavily indexed, it's going to be subject to forced selling from those outflows. All right, guys, long video. I'm going to wrap it up here, and hopefully you find these levels useful. This has been Randy Finney with Right Side of the Chart. Have a great day.